July 2, 1997, the Thai government abandons its currency peg to the US dollar. The baht immediately collapses by 20% in a single day. And what starts as a localized crisis in Bangkok becomes a financial contagion that destroys $600 billion in wealth across Asia in less than 6 months. Indonesia, South Korea, Malaysia, and the Philippines all fall like dominoes, their currencies collapsing, their banks failing, and their economies plunging into the worst crisis since World War II. Millions of people lose their jobs. Riots erupt in the streets. An Asian miracle that everyone thought would last forever ends in catastrophic failure. If you want to understand how financial contagion spreads across borders and why fixed currency pegs are time bombs waiting to explode, hit that subscribe button and drop a comment about what financial crisis we should cover next. Because the 1997 Asian crisis is a masterclass in how quickly confidence can evaporate and how interconnected the global financial system really is. In the early 1990s, Southeast Asia was the economic miracle of the world. Thailand, Indonesia, Malaysia, South Korea, and the Philippines were growing at 7 to 10% per year. Foreign investment was pouring in, skyscrapers were rising in Bangkok and Jakarta, and economists were calling these countries the Asian tigers, predicting they would soon rival Japan and the West. The growth model seemed perfect. These countries pegged their currencies to the US dollar to attract foreign investment, borrowed heavily in dollars to fund infrastructure and real estate projects, and kept interest rates high to maintain the peg and encourage capital inflows. But underneath this success story, massive vulnerabilities were building. Thai banks were lending recklessly to real estate developers who were building office towers and luxury condos that nobody needed. Indonesian corporations were borrowing billions in dollars but earning revenue in rupiah. Korean conglomerates called chaebols were over-leveraged and unprofitable. And everywhere you looked, crony capitalism meant that loans were being made based on political connections rather than business fundamentals. By 1997, Bangkok had the highest vacancy rate for office space in the world. Thai banks were sitting on mountains of bad loans, and the whole system was one shock away from collapse. The Thai baht was pegged at 25 to the dollar, but speculators led by hedge funds, including George Soros's Quantum Fund, started betting that the peg couldn't hold. They borrowed baht, sold it for dollars, and waited for the devaluation. This put enormous pressure on Thailand's foreign exchange reserves because the central bank had to keep buying baht with dollars to maintain the peg. By mid-1997, Thailand had burned through $30 billion defending the currency. Their reserves were almost gone, and on July 2, they had no choice but to give up. They floated the baht, and it immediately crashed. The panic spread instantly. If Thailand's peg could break, every other Asian currency peg was vulnerable. Investors started pulling money out of Indonesia, Malaysia, the Philippines, and even South Korea. Currencies collapsed across the region. The Indonesian rupiah fell 80% against the dollar in 6 months. The Korean won dropped 50%, and the Malaysian ringgit plummeted 40%. Companies that had borrowed in dollars suddenly found their debt burdens doubling or tripling overnight because they earned revenue in local currency but owed payments in dollars. Bankruptcies exploded, banks failed, and credit markets froze. The human cost was staggering in Indonesia. GDP contracted by 13% in 1998, unemployment soared, food prices spiked, and riots broke out in Jakarta that killed over 1,000 people and eventually brought down the 32-year dictatorship of President Suharto. In South Korea, the economy shrank by 7%. Major conglomerates like Daewoo collapsed, and the country was forced to accept a humiliating $57 billion bailout from the International Monetary Fund, the largest IMF package in history at that time. The IMF's response made things worse. They imposed brutal austerity conditions on the crisis countries, demanding that they raise interest rates to astronomical levels, cut government spending, close failing banks, and open their economies to foreign ownership. The logic was that high interest rates would stabilize currencies and restore confidence, but in practice, it just accelerated the economic collapse. businesses couldn't afford the high interest rates, more companies went bankrupt, unemployment skyrocketed, and the social fabric of these societies started tearing apart. Thailand's economy contracted by 11%. Malaysia imposed capital controls in defiance of the IMF. The Philippines barely avoided total collapse. And across the region, people who had been middle class were suddenly poor. Families lost their homes, students had to drop out of university, and an entire generation's dreams were destroyed. The crisis exposed the dark side of globalization, how quickly hot money could flow into emerging markets, and how even faster it could flow out when panic set in. George Soros became the villain of the story in Asia. He was accused of deliberately attacking Asian currencies to profit from their collapse. Malaysian Prime Minister Mahathir Mohamad called him a moron and blamed him for destroying Southeast Asian economies. But Soros argued he was just betting on the inevitable, that these currency pegs were unsustainable and the crisis would have happened anyway. The truth is, somewhere in between. Speculators like Soros accelerated the crisis, but they didn't create the underlying vulnerabilities, the bad loans, the crony capitalism, the overleveraging. Those were homegrown problems. The 1997 crisis changed Asia forever. It destroyed faith in fixed exchange rates. Most countries moved to floating currencies and built up massive foreign exchange reserves to protect themselves from future attacks. It discredited the IMF in Asia and created lasting resentment toward Western financial institutions, and it taught emerging markets that they couldn't trust international capital flows. South Korea restructured its entire economy, breaking up the chaebols and improving corporate governance. Indonesia transitioned from dictatorship to democracy, and Thailand rebuilt its financial system from scratch. If you found this valuable, make sure to subscribe and share this with anyone who wants to understand how currency crises spread and why pegged exchange rates are so dangerous, because the lessons from 1997 are directly relevant today as countries around the world struggle with dollar-denominated debt capital flight and the eternal temptation to fix their currencies to create a false sense of stability that inevitably ends in disaster.